My computer just froze. Okay, wait, you see me?
I see you.
All
Yep.
right, good. Let's pretend everything's fine. All right, welcome back to the next episode of the Ecom Growth Show. I'm your host, Daniel Coleman. I've got Oz Merchant with me, who some of you know him in the Amazon space, but most of you don't know that he didn't come from the Amazon space. So Oz, would you please introduce yourself? Tell us where you come from and why you have the authority to talk about the subject, which we're going to divulge in a moment. Why do you have that authority? Why should we listen to you? And what are you doing these days?
All right. Appreciate it, Daniel. Appreciate you having me on. So interesting enough, I actually started selling on Amazon back in 2005.
Man, I didn't even know that. Okay.
Yeah. So back in those days, I was selling on eBay, early 2000s. Uh, and, this Amazon thing was coming about. It's like, okay, let me go explore what it's selling like. So I was selling a lot of technology products. So just a lot of reselling. So I started selling on Amazon back in 2005 and had an account since then.
Wow. How much you
So
want for that account?
exactly. So I mean, that was the heyday. I mean, it's like there was no FBA, there was no ad platform, there was nothing. It was just basically competing against eBay. So it was like eBay is like you pay for Bold and you pay for all these little things they would nickel and dime you for. It's like Amazon's like, okay, you just go list it and it pretty much sells within a day.
Yeah, you didn't even have to have pictures back then.
No, you didn't really need anything other than just list it. List it and somebody's going to buy it. So just the demand was not nearly as great back then, but it was just a different time. Since then, I've been in the tech space for 20 years in high tech, building out SaaS companies. And one of the last ones we built out was a company called Viably, which was a lending platform for the e-commerce space. Essentially, basically, if you're looking for short-term working capital, this is the way to get some funding, which is very big in the e-commerce space. You need money to keep scaling up, and whether you get that through Viably, you get that through other means. You can bootstrap it, but at some point, you do need money to really scale.
Yeah. Little spoiler alert here, and hopefully I'm not saying this too soon, but I'm working with a company called TurboDash, who is aggregating all of the lenders, and you only have to fill out one form and it'll give you the rates and everything for everybody in a super simplified version. So you don't have to start off by having 15 conversations to get what you want. And it'll basically, and I've advised them to, and they're doing this, to basically explain all the different ways that money works, because if I loan you $1, it's not just loaning you $1, it's loaning you $1 against your inventory, loaning you $1 against your credit. It's just, and you could speak to it way better than I could, but the amount of ways that you can go get money is like, it's crazy. I had no idea.
Correct. Yeah. There's a lot of different ways to get money, and each dollar is not the same. I mean, it's a little bit different.
Right.
And what you're using it for makes a difference, are you getting the right kind of ROI on it?
Yeah, I was going to put it in my bank account and just let it live off the interest. That works, right?
If you have enough, yeah.
That's true, yeah.
So it's like, one of the things is if you get to $10 million, you can conservatively have 5-6% you're making on that and have a pretty good living.
Yeah. I'd like to do that. That would be a goal. Have 100 cup, just a cool $1 billion in investments, and then anyhow, all right, not the topic of this conversation, but so you were an OG, even more so than me. You're 5 years before me on Amazon, but then you come from the SaaS space, so actually scaling SaaS companies. And so perhaps this episode might be a little bit more toward agencies and other SaaS companies in the Amazon space, which is great. So should I just go ahead and start off with the first question?
Yeah. And keep in mind, I mean, look, the way I look at it is business. SaaS is one business model. Agency is a business model. E-commerce is a business model. But at the end of the day, business is business. The way it's going to work is, are you making money, and are your expenses less than what you're making?
Yeah. Fair enough. I agree with that. Okay, cool. Well, then why don't we tailor this first question to the seller? What's the best way to manage cash flow?
So if you're talking about to a seller, I mean, there's a couple of different ways. When you're looking at, one is looking at kind of your inventory and how are you buying inventory? What's the terms you're getting it on? So for example, if you are doing, which is common in kind of brands, they'll do 30% down payments, 70% later. But if your cash flow doesn't support that and you still want to make the deal, part of it is being able to negotiate, say, hey, I give you 30% now, 40% of the time of shipping, give me another 30 days to give you another 30%. You get your full money, but that extra 30-day window helps float your kind of the cash flow. Basically, okay, I don't have to come up with inside of 60-day window. I can, assuming 30-day production time, I can come up with it in a 90-day window. Now you've kind of just given yourself some breathing room to have enough sales come in that you can cover some of that.
Yeah, you're basically using the inventory that is being financed by the manufacturer to generate the capital to pay for what you're selling.
Correct. Yeah. I mean, ideally, if you could even get longer, that'd be better to the point where you can generate some sales off that round of inventory. If not, then at least you're getting that window of other sales that you've got with existing inventory to come in and help cover some of that.
I've talked about this before on the podcast. Who was I speaking to? Maybe Mark Botha from SellerView. So basically, there's just so many different ways. I think these days, now more than ever, you need to get creative with every aspect of your business and be smart about how are you using that money? Where's that money going? How do you save money? How do you make more money, right? And so there are just these little things. So Mark said the greatest thing, this is a real story with a client of his, where he said, if you walked past 18 cents, you'd probably just be like, whatever. But if you walked past it 2,000 times, well, that's $4,000. You might have started picking it up a little while ago. You know what I mean? And so this is one of those things like, okay, let's just say you're putting this on a credit card. I realize that's not entirely realistic for some people, but let's say you put it on a credit card. Well, instead of putting it on a credit card, let's say it's 10 grand, you put 3 grand on the credit card, then you go to the manufacturer, and this typically takes an established relationship before they'll float you like this. But you just go, hey, listen, here's what I'd like to do. I'd like to pay you for 50% of the inventory. You send it and hold the other 50%, or like what you just said, 30, 40, 30, or 50% now, because you know what you're getting. It's an established relationship. And then give me 90 days or 120 days to give you the rest. Or you get terms from them on payments. There's just so many creative ways to do this. But it requires that you be in good communication and have a standing relationship, right?
Which goes back to what I was saying about business. So one of the key facets of business is relationships. And if you're thinking of your suppliers, your manufacturers, distributors as partners, you're just going to engage with them differently. And with that kind of relationship that you forge, you're going to have just a lot more options than the person that's treating them as like, well, today I'm working with you, tomorrow I'll find somebody else. It's just a very
transactional.
Transactional, exactly. So if you're thinking long term with them, because look, they're in there to make money as well. So which goes to another piece of kind of how to think about cash flow is on the forecasting side. So the better you can kind of forecast, look, I think I'm going to generate this much in sales, and if I can communicate that to my suppliers, well, guess what? I mean, from a supply chain standpoint, they got to go get source raw materials to make that stuff. So the better they know and they can kind of forecast, okay, this person's going to need this much from me, then they can go out to the market and say, well, should I buy this much of this raw material because I can get a better deal if I buy it in bulk, or if it's something seasonal, if I buy it in this season, because we're talking about raw materials, some of the stuff is grown and mined and stuff. It's like I can get that at a better price, and by getting that earlier, I can increase my spread. Or if you're going to kind of push me on better terms or better pricing, I at least have more to play with. Because when you're e-commerce, you think, wow, I'm playing with low margins. Manufacturers are playing with even a little smaller margins. So it's all about a volume game. So
so they have to think in terms of futures.
Exactly.
Not only futures as in like hedging their bets on the material they're buying, but literally also futures of what's the future relationship of this client with me.
Correct. Futures of that, futures of what may happen climate-wise, depending on what products are being sourced and what the raw materials are. So they're having to factor in all these things to make sure that they can basically keep getting the raw materials in a way that they can make those products, and different customers are going to have different needs of using those raw materials.
Yeah.
So
once again, go ahead.
I was going to say, once, you can forecast that, you're just helping that relationship. And if you're a manufacturer supplier, you want to work with a person that can sit there and say, yeah, I've done my math, I've done my forecasting, here's my plan, whether you're off for here or there versus somebody just like, yeah, I need this much. Maybe I won't, maybe I will.
So, all right, that brings up a good question. Then would you suggest, I know the answer to this, and as soon as I ask it, everyone's going to know the answer to this right away, but would you suggest that someone come up with a business plan to present to the manufacturer as opposed to, I need 100 units of this?
Business plan, that's
I'm using that very loosely.
yeah, I was gonna say it's like, at the end of the day, all they need is context, right? So what is a business plan serving as? It's serving as context to where my kind of grander vision is, where I'm going, how I may be thinking about future variations, future SKUs to basically go launch, new products to launch. Some of it is proprietary. You may want to keep that closer to the vest. But at the same time, from a forecasting standpoint, helping them envision where you're trying to go, at least for the next 12 months, that's huge. And I think the stronger that relationship is and the better you can forecast, the more you can say, I can extend that out to 24 months.
Okay. So then we're segueing straight into my next question, which is understanding your numbers. Like, I come from Managed by Stats. Managed by Stats has always been about knowing and understanding your numbers, right? And has, in my opinion, expert opinion, mind you, has always delivered the best representation of the truest form of your numbers, so long as you are adding in whatever fees and stuff like that are actually happening. So how do you suggest somebody understand their numbers? And what are the ramifications of not doing that as opposed to doing that?
Look, I mean, having now probably looked at, I don't know, hundreds and hundreds of different financials with different companies from that standpoint, two things. One is people have for most of the time, people had a strong disconnect between their actual numbers and what they think they're doing. Meaning they're usually looking at one metric, and that metric is usually not the right metric to be looking at. It feels good maybe, but it's not the one that's going to actually, from underwriting standpoint or from
like
actual
sales?
Healthy business standpoint. Yeah, exactly. It's like,
Yeah.
that's not the right metric to be looking at.
Yeah.
So if you don't know your numbers, it's really hard to sustain your business. So, one of the things I always talked about, there's like a healthy business, there is a kind of not so healthy business, and there's kind of dying business. If you're healthy, you're strong, you're doing fine. If you're dying, then it's kind of obvious. It's everybody in between, because in e-commerce, it's such a cash intensive business. There's so much movement of cash that if you're not aware of your numbers, you can actually see the problems can stay hidden for a while.
Yeah, for sure. For years.
Yeah. And it's like, and then they'll sneak up on you. And it's like, at that point, it's usually too late, because you can't buy your way out of it. And that's what most people do, is like, can I just get enough sales and kind of spend my way out of it? Very rarely does anybody pull that off. You certainly can't access outside capital, because the moment anybody uncovers, looks behind the hood, it's like, yeah, there's the business is trending in the wrong direction.
Are you saying that if you need capital for saving, you're not going to get it?
Correct. So one of the things I would say is, if you need money, no one's going to give you money. If you want money, if your business is healthy, and most people, they tend to have some pride. It's like, hey, I kind of did this on my own and I didn't have to take any money. Great. I can certainly appreciate that. I understand that there's kind of some honor in that, to say, okay, I did this on my own. But at the same time, nobody's judging you for taking money to help grow the business, especially if you're kind of scaling it up. Other people that are working for you, they're depending on you, their families are depending on you. It's make the right business decision to help scale the business.
Yeah. And you know what, dude? I'll be honest, like, that's the position I'm in at this very moment. I'm at a crossroads. Do I go take money or get money, or am I trading equity for cash? Should I just go raise some debt, or do I continue to bootstrap? If I continue to bootstrap, my growth potential, my growth path is a lot slower than if I'm able to get some capital and dump it into marketing, for instance, right? And so I go, okay, let's say I go, all right, I need $250,000. What am I going to get out of $250,000, right? Will it exponentially, like, these are the things that I have to think of right now. Do I need $250,000 or $500,000? Or do I only need $100,000? How far is $100,000 going to get me? Not that far, but is it all I need? Right? Do I just need that little push Or do I need to go and give away 20% of my company for $1 million?
So a couple of things to think about there. So one is, if you're taking money and you don't exactly have that machine in place, then you're taking that money and you're experimenting with it. Meaning, like, if you know, okay, I figured out kind of all my key metrics that if I put $1 into this machine, that it'll generate $4, $5 from it, because I've figured out, the right kind of products to sell, the right price point to sell, my cash conversion cycle, how quickly I can take money, buy inventory with it, turn around, sell it, and get the money back. That cycle, I've got that kind of humming to the point where every dollar I put in, I get X number of multiples back. If it's not that level of a machine yet, and you're still experimenting, then you don't want to be kind of experimenting, guessing with somebody else's money, because you're just not getting good ROI, because there is a cost of capital. And if you're thinking about it from the machine in place, then it's about the ROI of capital, and the cost of capital is kind of baked into it. But if you don't, then it's just a straight cost of capital, meaning like it's costing you money to get that money, and am I getting a good return on that? So if you're trying to say, I'm going to go test ads and stuff with it, then you're kind of throwing darts in the dark, and you're not best utilizing that dollar.
Yeah. Funny story. I've actually thrown darts in the dark, and I haven't hit the target as often as I thought I would.
There you go. Now you bring up another point around the equity piece. And I think that's something most people don't think enough about. Trading equity is that the equity dollar is the most expensive dollar you could ever get.
For sure.
Most people think it's like, oh, well, I can just give a percentage of my company. It's not really costing me anything. But the reality is, if you're thinking about building a really good company, it's going to scale. That dollar is going to have multiples on it.
Yeah.
And that's going to be far more than you're paying for than you would ever pay on any type of interest.
Absolutely. And that was the conclusion that I came to, is like, well, I don't want to give away equity, right? Because if let's just say I got $100,000 for let's call it 10% of my company for the ease of math here. Well, when I'm doing $1 million, that $100,000, $1 million a month, that $100,000 is potentially $100,000 a month to the person that gave me that money, right? And so technically the interest rate on that $100,000 is infinite, right? Just you keep on paying for it. And, there are different ways of getting money in equity and angel investors, and do you form a board of directors and all this stuff. And if you give away enough money, or in some cases, correct me if I'm wrong here, if you acquire enough debt, then you have also acquired people with that money to tell you what to do. Not just with the money, but what to do.
Correct. So let's distinguish between debt and equity. Like, so you can give away equity. Debt is basically a promise you're going to pay somebody back.
Mm-hmm.
So you can take debt. That's fine, because you're not diluting yourself. You don't want to give up equity, because that's kind of your asset that's of value. That's going to basically get you a multiple. But to your point, there's a guy I used to work with about 15 years ago, was doing kind of some contract job. And they're like, hey, we can certainly pay you like the $1,000 we kind of discussed, or happy to give you these 3 Bitcoins. He's like, yeah, I don't know about this Bitcoin thing. He just took the $1,000. 3 Bitcoins. What would that be worth now for instead of the $1,000?
Yeah. What would it like two?
Yeah,
200 and something,
210, something like that. Or no, actually we're at 100,000 almost 300. Okay.
What is it? Geez. Yeah. Little side story. I used to have a wallet, a crypto wallet with some Bitcoin in it, and I lost it. It was on an old phone that got destroyed. And at that time, this is a long time ago. At that time, I didn't know that the wallet, that the key was that.
Yeah.
Yeah. And it's gone. I've looked for it. I tried to figure it out. I never found it again.
Reminds me, there's if you ever seen the TV show Silicon Valley on HBO, there's a whole scene where the guy has lost a thumb drive. He's got 300 million in Bitcoin sitting on it. And he just can't. It's going through the dump. He's hired a whole crew of people to go through the dump to find the right pair of jeans with the thumb drive on it.
Oh my gosh. Could you imagine? Whoops, I accidentally threw $300 million away. Yeah. All right, cool. Well, let's get on to the next question. Thanks, Oz. This has been actually super helpful. Let's talk about scaling and like building and scaling a team. That's actually something I'm doing right now. I've just hired my very first full-time person. I am training her. She's also training me. And Like, who was I speaking to? Darn it. There was a book called Buy Back Your Time.
Did Dan Martell?
Yes, which I haven't read yet.
Good book.
Yeah.
Yeah, really
So,
good book.
okay, cool. So let's talk about when is the right time to build a team? And like, it's kind of funny. I didn't actually expect this conversation to be relevant relevant to my company, but so I haven't even paid myself yet. I haven't paid myself in about 4 months, right? But I've hired a full-time employee. So would you say I've made the right choice or the wrong choice? And I realize there's way out of context, but
Yeah.
in general,
Look, I mean, the way I look at it is a couple of things. One is if you're familiar with EOS, there's a model around kind of right person, right seat. So you're making sure you're hiring the right people to do the right kind of jobs. And when you think about what needs to in the business, what does the business need at this point in time? Are you offloading kind of tasks so that you're getting better ROI of your time onto something that's more lucrative and just helping the business grow? Is it because you don't have domain expertise and you're trying to bring that person in because they have some level of skill set that you don't and you're trying to augment that? Or is it that you just don't like doing that part of the business? And if you did it, yes, you could, but you just kind of feel like you enjoy your day less and you're like, okay, I'm willing to trade money to have somebody else handle that and I don't have to deal with it.
yeah.
So,
Well, I think it's probably all of the above for me. So perfect. I made the right choice.
yeah, I mean, that's the way you kind of look at it. It's like, because you feel like you're going to feel like you're getting good ROI at that.
Yeah.
And you just have to know enough about what they're doing to be able to
manage
manage it. Yeah. To
Yeah.
say, okay, if you're totally in the dark, then you don't know that, okay, are they doing a good job or bad job? If you have some way of saying, okay, yes, then they're moving the needle forward and I have some kind of benchmarks to look at to say I'm getting a good kind of return from bringing them on to the team.
Yeah. Cool. All right. Awesome. And so let's see. What more should you tell me? What more should I ask about that? Because right seat, right person, right person, right seat, EOS, yep, makes sense. But what about cost, right? So I have to take into account that I'm going to take this money, and to me, I would typically think, what's my ROI on this person, right?
Think beyond that, though. It's not just because now if you've offloaded something, it's the ROI for this person. And inside that ROI as a whole is, what did that allow you to do now? So the ROI should be contain both their output and now your new level of output.
That makes sense. Okay, cool. Yeah, then I would say I definitely made the right decision because, being a one-man show in the company, marketing, sales, delivery, customer service, all legal, all of that stuff, right? And that is time consuming. And really, I can only dedicate my time to one major area at a time. And so I'm either marketing or I'm doing sales. If I'm not doing sales, it's because I stopped marketing because I had to do sales, right? And so I have this up, down, up, down, up, down of where I've got a full week of meetings and then a half week of meetings and then a week of very few meetings in which I am, all right, I got to get on podcasts. I got to get on webinars. I got to get on the newsletters. I got to, be marketing. And so the person I've hired, she's awesome. And she's basically come in and be like, okay, cool. My job is to make it so that you have the time to do your job. Like,
Nice.
yes, that is you. That's what I need. And she's doing a great job of it, handling the administration, because with every client I bring on, there's a whole administrative cycle and it's quite time consuming,
Yeah.
So,
Yeah.
all right,
So
cool.
those type of things, like I said, make a big difference because you're helping kind of elevate the business as a result of that. So it's a investment. Yes, there's costs associated to it, but if you can get instead of from 1 to 2, you can get from 1 to 3, 1 to 4, then the ROI was worth it. You may suffer it kind of in the early days until the math kind of justifies it, but you're investing in the future of the business, not where your current situation is.
Yeah. It's a very, very funny, totally different point of view being an executive in a company, hiring an employee than being an employee being hired by an executive. Because as an employee, you think, how much dollars will I make, right? As an executive, you're going, how much is it going to cost me to find out if this is the right person, right? And when you're hiring employees, most employees don't realize if they're getting paid $10 an hour, it doesn't cost the employer $10 an hour. It's like $13.50 or something like that, right?
Yeah. There's a lot.
So, yeah. So,
and that's why it's always best to kind of hire slow, fire fast. Kind of a big believer in that philosophy.
You broke up there for a second. What was that?
I said I'm a big believer in that philosophy. Hire slow, fire fast. Take the time, make sure you know what you're hiring, who you're hiring, what you're hiring for, and you have a way of kind of gauging performance and success. And then once you hire them, work your butt off to make sure they're successful, because it doesn't stop with you just basically hiring them. Then now they got to go do it. It's your job to make them successful in their function and role.
Yeah. So that was a rude awakening for me, is when I hired an executive assistant, assuming they knew how to be an executive assistant. I mean, that's what they said, and luckily she had the gumption to tell me, like, I don't think this is working out. I had to get it out of her, right? So 24 hours, I was on a call with her and just bringing her through my day. I said, okay, cool. Today's day one for you. I'm going to bring you through my day, right? And at the end of the day, or the following morning, she texts me like, I'm really not feeling well. I've got a terrible headache. I'm like, yeah, cool. All right, cool. Get better. This is day 2, right? And then a little while later, I'm just like, hey, did I overwhelm you with yesterday? And she's like, yes, you totally overwhelmed me. I'm like, cool. Are you unable to handle the level of stuff that I have to go and do? And I told her, you have a completely open line of communication to me. You may say whatever you like, and I will not be offended. Answer me with what you truly feel, right? And she's like, I could not possibly do this. You have too many things going on, and there's no way I'll be able to do this. I'm like, awesome. Thank you for letting me know. And luckily, unfortunately, I had just spent money with like Google and Slack, and I literally just spent days prior to her first day getting her set up, only to find out within 24 hours that she's can't possibly handle me, right? And the second person, though, it was a similar situation, but I tried to reduce the amount that I exposed her to, right? And so this is week 3, and she's doing an awesome job so far, Anyhow, right.
But that speaks to kind of when we're talking about hiring stuff is, there's the people part of it, but the other's process. So then it's like a great opportunity to take a look at the process. Is it a matter of, don't overwhelm them and kind of ease them into it? Or is it, okay, you know what? I'm going to hire them. I'm going to walk them through this day one, and I'm not going to get anything set up for them. I'm not going to get them set up on Slack or Google or anything else, and see how they do at day one. If they run after day one, then I know that basically they're not the right fit. It's interesting. Some people approach hiring as is their job to make somebody feel welcome. Well, especially when you have a team of people that are responsible for hiring, it makes it easier because everyone can kind of fulfill a different role. Mm-hmm. One of the things I always like to do is I like to scare people with the reality. This is the day in a life, and it's not fun. There's no glamour in it. This is just what you got to do. And if they're not like, okay, yeah, I'm so excited about it after that, then it's like, okay, then I'd rather them kind of think that, adjust that, and say, okay, well, this is what you're going to have to be doing on a day-to-day basis. If you're not going to enjoy that, probably not a good fit.
Yeah.
So,
yeah. And I basically did the same thing with the second person, just not as much. But yeah, I told her, look, I've got knife company, adventure company, video editing for this. I've got a podcast. I've got 6 websites. I've got Amazon stuff. I've got a software company. I've got this, that, and the other. I've got 3 kids, and what you see is what you get, And if you're going to be my executive assistant, you're going to be helping me with every single one of those. But instead of exposing her to every single one of those first, I just went, cool, let's go over this. This is the most important thing first. So I learned the lesson of prioritizing the things that are most important and then starting there, because I have no SOPs in place.
Yeah. And that's what it's about. I mean, it's part of that is saying, okay, if you were just to take a moment and organize your own day to say, where is the best ROI for me? Meaning, where can I buy back my time the most? Then, and is that something that's, easy for me to train up somebody on? Then I'm winning, they're winning because they feel like, okay, it's piecemeal. I can take that and I can run with it. And you feel like, okay, I got a good chunk of my time back as a result
Yeah.
of it.
Yeah. Yeah, exactly. Yep. All right, cool. Well, let's go into the next question, and that is when and where to get capital. And I know we covered this in the beginning, but we didn't exactly cover when do you do it and where do you do it.
So when, I think I touched on a little bit, is when you are doing well.
Yep.
Meaning like if
Yeah, we did
business,
touch on that, but
if
but
if
let's take me for example. I'm doing fine, right? I'm scaling to 3 months in, I don't know, 50% growth a month right now, right?
okay, yeah,
With
the
roughly,
trajectory needs to be going in that direction. So most people will happen is an event will happen and they'll start seeing a downturn and then it'll be another, they'll think, okay, it'll bounce back and they'll let it go another month or another 2 months, another 3 months. It's like, oh, wait a minute, this is not trending the right way. Let me go get I'm going to need some money. Well, if you're trying to get money at that point, you're already showing a downward trend. And remember, from an underwriter standpoint, there, especially in this space, since nobody's giving you hard assets to collateralize. I guess you're not collateralizing your house or something for that money. So it's really based on your sales and performance. So if they see a downward trend, then it's too late. Then it becomes like, okay, well, how are we going to fund them? Because they're trending in the wrong direction. Unless you can really make a solid case for, yes, I know exactly what I did wrong. I'm going to do this differently. And you're going to start seeing an uptake. I just need a little bit of money. And maybe you get a little bit and you start building that relationship. But, comes back to also relationships, just like we talked about on the supplier side. The three people you don't want to lie to is your attorney, your accountant, and your banker. All three are there to help you become successful. So forge those relationships and think long term.
I'm just going to add one more in there. Your wife.
I figured that was a given, or any support system for that matter, really.
Yeah. That's true.
Yeah. But once you have that downward trend, it's really hard for someone to say, I can underwrite that type of business. So if you're trending up, great. If you're even kind of staying consistent, great. At least there's kind of consistency in that because you're betting on how you're going to continue your performance. Okay, if you can say, well, I'm doing 12% net profit and I'm doing consistently over the last 18 months, great. Okay, you got a healthy business.
Yeah. Okay. So what about where to get capital? And I'd like to start off with my list. And this is, by the way, everyone listening, this is completely unscripted, right? So the ways that I know to get capital, obviously I can get a line of credit, which basically is like, here's $10,000 available to use, right? But you only pay for it when you use it, right? I can get a loan. It's like, okay, here's $10,000. You're going to pay us $300 a month on this $10,000 at an APR of 10%, which is compounding. So you're not paying $11,000. You're paying $14,500, right? So every dollar that you borrow costs you a lot more than $1 to repay. Costs you $1.40 or something like that, right? You can get a small business loan through SBA, like a 7A loan. And I think those are $50,000 to $5 million or something like that. They're supposed to have favorable terms, but terms today, if I'm not mistaken, are not that favorable.
Still one of the best you can get. Yeah.
Still one of the best. Okay, good to know. Because I think I was looking into it. I think it was like 12% or something like that. So 7% plus something.
But you're usually getting 10 years to pay it back too.
Okay. So you've got long terms on that. All right. And then let's see. So credit card line of credit, bank loan, government-backed small business loan, private equity, private equity going to an equity firm and they go, oh, cool, we'll inject you with this much capital. Angel investor, which is, hey, I'm a person, I invest and I'll invest in your company. And I know that there are groups of angel investors that pool their money because they expect 90% of what they invest in to fail. What else?
So I want to bucket those in two different buckets. So there's
Okay.
debt dollars and equity dollars.
Yeah. Cool.
So
Yeah,
the private equity, the venture capital, the angel guys, they're all equity dollars. And you're trading equity for those dollars, and they're expecting money, multiples of that down the road, which is probably the most expensive kind of money you can get. Now, if you're asking for dollars that aren't justified from where you sit, meaning like a bank or any type of loan you're going to get, they're going to look at, there's a loan to debt ratio. So, okay, how much you have outstanding? How much is your business doing? I can only extend you percentage of that. Well, from an equity standpoint, you can get, go raise more than what you're actually making in revenue.
Yeah.
So they're taking a bigger gamble on you, but because of that, they're expecting far better returns.
Yeah.
So when you look at the debt dollars, line of credit, unless you're big enough, you're really not going to qualify for it. It's not easy to get, especially in the space, meaning that line of credit. So there's a couple of things to look at. One is, do you want personal guarantee? Are you really committed to that money, and you're committed to the business to the degree you're putting your own neck on the line? Because that's what you're doing with a lot of these things, long-term, like term loans, line of credit. You're basically personally guaranteeing that, meaning that if anything happens to the business, you're still on the hook at a personal level. The other thing you want to consider is, what are you really trying to solve for? What's the window of capital that you're trying to solve for? Is it, I just need, a lot of times people just need this small window of capital of like, I need to go buy inventory, and then I can sit there and just have it rolling. So if you know that I can turn inventory 4 times in a year, and if I had infusion of cash, I could go to 6 times a year, because that's where you make money, is how quickly can you turn inventory.
Yeah. Cash flow.
Is the cash flow in the inventory turnover. So the more times you can kind of take that dollar and recycle it through, if you can do that 4 times, you're going to make so many dollars, because if you know the profit against that, if you know that I can do it, 6 times, I'm going to make so much more. So you're using that outside capital to speed up that process and help you hopefully achieve just more turns.
Yeah. Cool.
So, and then if that's the case, then how much do you need, and what's that cash conversion cycle window that you're trying to cover? If it's 60 days, then maybe that's all you need, a 60-day window, but you need it multiple times in that given year to achieve that. If you're thinking long-term that I want to take an SBA loan, you've got 10 years. That's just kind of money. What happens is most people will quickly absorb that money into their everyday operational stuff. And now you've basically added a new line of debt on the business, on the books for the next 10 years.
Right.
And you never felt like you got like a good win off of that.
Yeah.
It just kind of helped give you a little bit of cushion, some breathing room. Just sometimes that's all you need. I've seen businesses, that's exactly what they needed. And a lot of times with SBA loans, it's actually a good sign from an underwriting standpoint, because they're like, okay, somebody believes enough in you and what you're doing that you qualified for that SBA loan. So that works in your favor.
So you're saying that if I had an SBA loan and I were going to get more money, it's a good sign because I was already qualified for an SBA loan and got one?
It helps. So let me put it this way. It's like, it won't hurt you. Most people don't look at that as saying as a ding to say, okay, you got an SBA loan. If it won't, it's either neutral or slightly positive. It's not to the point where it's detrimental, because it's A, you qualified for it, and B, you've got like a decade to pay it off in, and they know that you're personally on the hook for it. So.
Yeah. Okay. Cool.
So then you want to look at, am I getting money against inventory? So some will do, alternative lending options. So there's kind of traditional bank options, which are going to be your term loans and your line of credits and SBA loans. And then there's kind of the alternative lending market, which is really looking at revenue-based financing or inventory-based. So meaning that they're essentially buying your inventory and turning around and reselling it to you. And they want to have that kind of middle position so that if anything happens, then at least they have kind of lean against that inventory and they can liquidate it.
Yeah. And some of them, I know, they've got their own 3PLs. So if they lend you money, you have to use their 3PL, which of course you have to pay for. It's a pretty good system, because for them, it may not be such a good system for the seller. But then again, I don't know. If my lender also warehouses my inventory, then they're on the hook to make sure they do a good job of making sure it gets out the door, right?
Yeah, and there's alignment there.
Yeah, exactly. And if you're going to be paying for it anyhow, I don't know, maybe you get slightly better terms because you've taken money from them. You know what I mean?
Yeah. Now, keep in mind, giving money and running a 3PL through very different set of skills. Hopefully they're
sure.
well versed in both.
Yes. Yeah. Because, yeah, being a 3PL is fairly easy to screw up for Amazon sellers because it's not just hey, I got an order, please send it out for me. It's like, I need this inventory shipped here, 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 here. A lot more to it. Okay. Well, let's talk about exiting your business. So I've spoken to quite a few lenders and agencies that help people sell their businesses, and some obscene number of, specifically us in the Amazon space, some obscene number of us never make it through due diligence because the numbers are so wacky, and I dare say many of us don't truly know how to run a business. I certainly add myself in that category, and I have been doing this for 15 years, and I still know that there's a lot I don't know and or implement. Like, all my Seller Central accounts are still under one corporation. They have been since the very beginning. Now, I don't sell the same ASINs across the multiple Seller Central accounts, but I know not to break the rules. But I have other companies that are underneath one S Corp umbrella. I have DBAs. And it's just like there's a lot of different things that I could be doing to better organize my stuff. And what I've learned along the way with all of these people and all these conversations is start doing it right at the beginning, which means learn what the right way to do it is at the beginning. And so you need to go find the people that know how to do it. So what do you have to say about thinking about an exit? Because I know that if you haven't done it right from the first get-go, which is probably most everybody listening, how do we exit the company?
So when you think about exits, first is understand. So every business has like a cycle, meaning that, you got into doing that business for, you had a motivation of some sort, whether it was to, I want to have this great idea for a product, I want to take it to market, or I want to hit a certain dollar amount and kind of feel like that I've achieved something, or hit
you
the
just want
sales
that
target.
Instagram digital nomad life.
Yeah. So whatever it was, there was something that got you started. And then, there's challenges along the way, but every business also has a kind of a peak. It's like there's an arc that, we get to the point, and after that, you're like, man, I'm doing this again day after day. And you start losing that enthusiasm and the joy of doing that business. So ideally you want to sell that business either as you're getting to the top or right shortly thereafter. Because if you wait too long, then you're just having miserable days. And when you start talking to people that are potential buyers, you're giving off that, I'm just trying to get rid of this business. So you're going to probably get a lot smaller multiples on it.
Yeah.
So you want to sell it when you're still excited about it and believe enough that, somebody's like, oh, okay, I want to be part of that. And let me see, I can do so many things with it. Not that somebody's just trying to have a fire sale and get rid of it.
So let's say this. I know that buyers they're looking for that hockey stick, right? They want to see exponential growth over what a 24 to, is it 2 to 5 years, or after 1 year, something like, basically they want to see growth year over year and month over month, right? And so are you saying that, let's say I'm scaling a business and I've been doing it for 2 years now, I've hit $1 million, I've been increasing by a respectable margin every month, and I just hit $1 million in revenue. You think it would be better for me to sell as I can show my statistics are rapidly increasing, as opposed to getting it to a plateau of, say, $4 million?
Depends on what you did to get to the 4 million. So there's a couple of things to consider. I mean, one is, when you're selling, is it that I feel like I don't either have the knowledge, the access to capital, or maybe the business requires the next step is really to take this internationally.
Mm-hmm.
And I don't want to be the guy that does that. So you have to decide what's your kind of motivation to sell. Is it because that, okay, if I go sell this now, I know somebody out there that's got deeper pockets or has a better network that can really kind of fulfill this vision, take it to a much grander scale. And that this is a great time for me to kind of part ways with it and maybe go start the next one. So one is kind of exploring that. And so if you got to that 4 million, got to that plateau because you've already found all those other opportunities, then it's also somebody's looking at it, it's like, well, I don't know what value I can add. It's like, if is that the extent of this business, it can only be a $4 million business, then it's less attractive to buy. It may have been better to sell it at 2 million because somebody could say, yes, I know the strategy to go from 2 to 4. At 4, it may have been like, okay, for that particular
Tapped out.
product line, you've just kind of tapped out everything that you could possibly do with it. So you want to
And so you're saying at that 4 million mark that I would receive a smaller multiple because of that.
Or may not even be able to sell it because of that, because somebody's like, okay, they have to figure out where it fits. Okay, maybe from their standpoint, it's like, well, this is a $4 million business, but it's encroaching in our other business, part of our other products that we have. And we'll either buy it because we roll it in, or we'll buy it just to kill it off because we don't want the competition in the space. So they have their own motivations for how they see it fitting into their overall, if they're single buyers, one thing. If it's a portfolio and they're looking at it from a portfolio standpoint, it's very different.
Yeah, gotcha.
So there's always usually a buyer for it, but it's just their motivations are going to vary.
Awesome. All right, cool.
So one other thing I'll say around that is just goes back to knowing your numbers. So, I was working with a seller, and he was like, it's a couple of years back, and he was like, yeah, I'm thinking about, an exit in like 2026 and stuff. I was like, okay, great. Start, looking, getting your books together and such. And how are you handling that? He's like, oh, I've been just using TurboTax and stuff. I was like, yeah, but you're like a $4 million business, and you're still doing everything through TurboTax. I was like, yeah. I was like, there's just like fundamentals you need to have of kind of financials and stuff in place to have an exit.
Yeah.
So knowing your numbers and having a clean set of books is huge.
Yeah. So there's a couple of people out there that can do that. Gosh, I wish I had them off the top of my head.
I have a whole platform for them.
Yeah, I was just going to say Ecom Sellers HQ, right?
Yeah.
Yeah.
You can find all the M&A folks there, the legal people that can help with that as well.
Yeah. All right, cool. Well, let's end this off with, it's all well and good for us to talk about this and tell you what you need to know and what you need to be doing. But when it comes to the implementation of a solution, Oz has actually built a platform where you can filter the type of company or agency or anything that you're looking for. And as a matter of fact, I dare say, Oz, I've been just a little tiny part of it since the very get-go, because you provided my list of all the parties, not parties, all the events and stuff like that, and you built out a whole events calendar.
Yeah, you were one of the first people probably that I talked about it as well.
Yeah. Well, happy to have a little bit of, I'm going to call it sweat equity into that, although from a very distant point. But so that's ecomsellershq.com. So if you're not aware of that, that's a really good resource. And then regarding
in the journey, so whether you're launching, scaling, or exiting, it's the whole idea is just carved out the whole ecosystem for e-commerce, put it all on one platform.
Yeah. You know what I'd love to do at some point, and it's going to take a lot of work, I think, but to build a super basic course on maybe even just a module. These are the things you need to know about. Here are the resources for those things, right? It's not a crazy course where it goes into great detail and stuff like that. It's just, you need to know this. Here's a little bit of data about it. This is why you need to know it. This is how it affects your future, your past, your present, all this stuff. And then these are the resources for those things. I think that would be very, very helpful to probably just any business, even myself. Like, you and I have been in this space a long time. Like, I've been in the space of strategic partnerships and stuff like that for Amazon businesses for almost 7 years. And there's still stuff that I find out every single month when I'm talking to people that I went, oh my God, if I'd only known this 10 years ago, it would have been like, in many ways, had I known the things that I know now about my business, not saying I implemented them, that's a different conversation, but had I known when I hadn't already established everything, it could have been a game changer for me. So, by the way, thank you for building that. I use it myself.
Yeah, and because the thing is, you're gonna use certain tools because of the size you're at, then you're gonna outgrow it, and you're gonna find the next set of things you need. And the whole idea is to have it all reviewed by sellers. So it's not like I'm saying this is good or bad. It's like, look, this is your community. This is, luckily, the Amazon, the e-commerce community, it's very close, it's tight. They're very supportive. It's one of the best I've seen in any other industry or other industry. So it's like, just go use it. It's totally free. So go use it find what you're looking for, leave reviews for whatever you have experience with, and just you're helping, pay it forward.
Yeah, cool. Well, Oz, thank you so much for being on here. This has been super valuable data, and I realize that a lot of people listening to this, you already knew some things about this, but hopefully this has pointed you in a little bit more of a laser-focused direction on what you need to be implementing and what you need to be doing. But if I could give one takeaway piece of advice on this, is that do your best to organize your company, your numbers, and everything as soon as possible. Make it so that you plan to sell, even if you don't. Pretend you plan on selling your business, because your organization, your numbers, your profits, your administration of everything is going to be better for it. And that's the one piece of little takeaway. If I could have anyone have from this, I hope they have that.
Yeah, and I would add, just when you do that process, what you'll end up start doing is helping you move out of the business some more. And when you can move yourself out of the business more, your multiples go up.
Yeah. Because if you're working in your business, you're working in it, not on it.
Yeah.
You're an employee of your own self rather than an executive.
And they don't want to buy you, they want to buy the business. So
yeah, exactly.
If you can plug your way out of the business, then they're like, oh, okay, the business can run by itself. That's a lot more valuable.
Yeah. So that's SOPs and policies and all that stuff. And if you can turn the jobs over to someone to run it for you, you truly can become an executive running the business from above. And then you can go do something else and do it as well. And then you build that up, you scale it, you turn everything over. And that's how I realized that people that run multiple businesses, they're not the CEO, founder, salesperson, marketer, and janitor,
Exactly.
And yeah, okay, cool. Well, once again, Oz, thanks so much.
David, thank you. Appreciate
you
having me on.
Thanks everyone for watching, and I'll see you in the next episode.